Today I will be discussing about private placement memorandum, due diligence, and term sheet. A private placement memorandum is a legal document that companies use when they are seeking to raise private capital. It describes the type of securities that the business will offer and lays out all of the details of the investment's opportunity to potential investors. Therefore, it is similar to the prospectus for a public company when seeking for an initial public offering. For a PPM to be valid, it should include a well-written business plan, a detailed use of proceeds, and a strong term sheet. The PPM meets all legal exemptions, and so it does not have to go through the extensive paperwork nor through the expenses from registering with the SEC, although it does go through some parts of the SEC. The PPM follows three different rules in Regulation D. Rule 504 are for firms that are trying to raise up to $1 million in capital. It allows all investors to invest as long as the capital doesn't exceed the $1 million. Rule 505 allows up to $5 million per year, but only mainly to accredited investors. Rule 506 is for offerings going over $5 million per year for accredited investors as well. Rule 144A, convertible transactions, is only for qualified institutional buyers that manage over $1 billion in assets, while Regulation S allows for private offerings to foreign investors. Due diligence is the right to do research on a company you want to invest in before actually signing or accepting a contract. Several individuals can perform a due diligence, such as corporate staff, attorneys, investment bankers, and accountants, just to mention a few. Section 11 of the Securities Act of 1933 protects brokers from being accused of acting unfairly if they exercise the due diligence. This section is usually called the due diligence defense. There are several possible areas in a due diligence to audit, such as legal, production, management, information systems, marketing, and macro environment audits. But the most important is the financial audit, and that's because it contains three different parts to it. The first part, companies need to explain how the business is planning to use the funds being provided. The second part would be explaining the company's model and their budget, and the third part would be for legal reviews. A term sheet is a document that sets forth an agreement between a business owner and an investor. It is usually prepared by a venture capitalist, and it's a non-binding paper that is signed, but it's not official until later when all the documents are done and finalized. There are usually different term sheets that specify different terms depending on the stage the company finds itself. For example, a seed capital term sheet only concentrates on seed capital, while A and B term sheets are for companies that are in further stages. There are many provisions and clauses that investors require in order to protect themselves. These could have a very big impact on the return of the company, so therefore entrepreneurs should be aware of things like preferred stock, because preferred stock usually get preferences when dividends are paid, and they really never go away. The dividends paid on these stocks range from 5% to 15% based on the return of the preferred stock. So it's always best that entrepreneurs negotiate for the lower amount. Investors also want liquidation preferences in case of a bankruptcy, so that they will be the first ones to get money back. Lastly, there are drag-along rights, where the minority of shareholders agree to sell or liquidate the company if it doesn't perform as promised, and therefore getting nothing in return, and venture capitalists get something back.